Hi there, welcome back to my channel, The Value Creation Playbook. I am Raja Mukherjee and this is episode 41. I want to start with a number, not a dramatic one. I would say rather it's a quiet number, the kind that is in your management accounts every month and never quite gets the attention that it deserves. Your days sales outstanding, your DSO. How long on an average does it take for your business to collect cash after an invoice goes out? If you know that number on the top of your head, you are ahead of most CEOs that I work with. If you have to think about it, or if you would want to check, stay with me because by the end of this episode, you'll understand exactly what that number is costing you and exactly what you need to do to change it. This, ladies and gentlemen, is episode 41, The Receivables Trap, Why Fast Growing Companies Choke on Their Own Success. Let me describe a pattern I regularly see in most mid market businesses that are going through this similar market growth challenges. Revenue is up, maybe 20, 30, even 50% year on year. The sales team is hitting targets, new consumers getting added, new customers getting added. The P&L shows growth, and yet somehow the business is perpetually short of cash. Payroll is getting little tight every other month. Supplier payments get delayed by a week or so. Your credit facility gets drawn more often than it should be. Your finance team knows something is wrong. You, as a CEO, know something doesn't really feel right. But the dashboard shows green. So the conversation really never happens. This is the receivables trap. And the reason it's a trap because it feels like a cash flow problem but is actually a working capital architecture problem. The two look identical from an outside. Both produce the same tight cash position, but they're completely different causes that are driving this behavior. And of course, they have completely different solutions. The cash flow problem means that the business is not generating enough cash from its operations. The receivables trap means the business is generating plenty of cash. It is just sitting in your customer's bank account instead of yours. This is the fixable problem. And today I'm going to show you exactly how to fix it. The receivables trap is produced by three structural conditions. You do not need all the three to have a problem. One is actually enough. But in most businesses I've worked with, there is a significant mix of all the three at the same time. The first condition is the payment terms that have crept upwards and outwards over time. You started with net 30, then somebody told you it's a critical customer. The net 30 became net 45 and then moved to net 60. Then net 60 with the 14 days processing windows means you're waiting for 75 days to get your payment back. The second condition is collection process that runs on goodwill rather than the structure. The invoice goes out, a gentle reminder is sent when someone remembers. The customer relationship is the most dominant consideration in every interaction. The third condition is growth, and that has outpaced the working capital architecture. At 10 million in revenue, informal receivables management was manageable. At 30 million, the same approach means there is 3 million that is sitting outside your books, in your debtors books, cash that is yours by right but unavailable in practice. The business grew. Of course it grew, but the systems around receivables did not. Before we get into the fix, I want to give you a framework for thinking about receivables. in a broader context, because DSO is not the only dial on the working capital instrument panel. It is one of the five. The metric that ties them together is the cash conversion cycle, or CCC. The formula is there on the screen for you to look and understand and grasp the nuances. But essentially, the lower your CCC, the faster cash moves throughout your business. A CCC of 25 days means you turn a sale into cash in 25 days. The higher the number is definitely not good. The fifth dial I track is early payment discount, not a standard metric, but an important lever that I'll come back to. Today we are focused on DSO. It is the dial that has the most direct management lever, which can have a direct bottom line impact to your business, but unfortunately is one of the most neglected ones. And let me tell you what I find when I ask leadership teams about the DSO. In about 70% of the cases, the CEO either does not know the current number, knows it approximately but cannot say whether it has improved or worsened in the last 6 months, or knows the number but has no target and no one accountable for moving it. Industry benchmarks for DSO vary, but as a general guide, B2B services business models will be targeting around 30 to 45 days, manufacturing 35 to 50, distribution 28 to 40, and so on and so forth. But now let me make this more concrete. Take a business with, say, $30 million in annual revenue. Current DSO is 15 days. Industry benchmark is 35 days. That is a 25-day gap. The cash is locked up, and the $30 million divided by the number multiplied by 20 gives you a number that is staggering. A 20 days reduction in DSO on a $30 million revenue base unlocks around $1.64 million in cash without a single new customer, without a single new product, without a single price increase, just by collecting what is already yours faster. Every additional day of DSO locks away cash equal to our annual revenue. That is alarming. At 10 million, you have a number that you can still manage, but at 30 million, that number really eats up into your profitability and your balance sheet health. The formula is simple, and the actions are also simple as long as you focus on them on the right direction. The number that comes out is the cash recovery opportunity sitting in your receivables right now. And here is the thing that always surprises people when they run this calculation for the first time. The number is almost always larger than they expected, because DSO creep happens slowly and the cash cost is distributed across every transaction. It never shows up as a single visible number until someone does the arithmetic. Now let us diagnose why receivables bloat happens, because you cannot fix what you don't have correctly, don't really know the root cause about. Root cause 1, no structured collection cadence. This is the most common cause and the most fixable one. Invoices go out, reminders go out when someone remembers. Escalation happens when it gets politically uncomfortable. Root cause number 2, payment terms are commercial without financially governed properly. The one tends to land uncomfortably in the room when the sales director is present. And I want to be fair to the sales team here. Their job is to close deals, and extending payment terms is a legitimate commercial tool. The problem is not that they use it, The problem is that nobody ever calculated the working capital cost on the terms that they agreed. Root cause number three, invoice disputes just left at the mercy of a resolution that will find its own course. A disputed invoice is a frozen invoice. It will not be paid until the dispute is resolved, and in most businesses, disputes go into a queue, an inbox, a spreadsheet, a recurring agenda item that never get quite the full attention that it deserves. Meanwhile, the cash just sits outside the business. The fix for the root cause one, the lack of a collection cadence, is straightforward. It's a three-step process that removes the awkwardness, clarifies ownership, and collects cash predictably. Step 1, invoice and confirmation on day 0. Issue the invoice immediately on delivery or milestone completion, not at the end of the month. Step 2, structural reminders. Day 7, a friendly note confirming the invoice and requesting a payment. Day 21, if still unpaid, a formal reminder that references your payment terms and notes that the invoice is due now. Each of these steps is templated, owned by a specific named individual so that there is no ambiguity. Step 3, dispute triage. Every disputed invoice is logged within 24 hours of the dispute being raised. Root cause is characterized, PO mismatch, delivery dispute, pricing error, etc. Resolution SLA is 5 working days, kind of standard. Make that a standard if it's not there. There is a weekly dispute review that involves both finance and operations. Because here is the insight about the invoice dispute that most businesses miss. They're almost never a finance problem. There are a cross-functional process failure, usually between sales, operations, and finance. The finance gets left to manage alone. And in a business where all these three steps are implemented properly, we will definitely see a reduction in the average DSO by over 2 weeks within a 90 days of period of a rollout. Two additional levers that most businesses either underuse or misuse. Early payment discounts. That is with the one that I was telling you earlier. The concept is simple. You offer a customer a small percentage discount if they pay significantly earlier than their standard terms. The question is whether the math makes sense, and it depends entirely on two numbers, the cost of the discount and the cost of your working capital. And when an early payment discounts, they are offered without the math as a general gesture of goodwill, or when they are different percentages offered to different customers, that's where it becomes more and more complex. But use them selectively with a clear calculation on customers whose payment behavior is consistently slow. Process automation, technology, and this is one area where I keep coming back to. Technology helps you a lot, but unfortunately does not fix a bad process. I would say that this is because I've seen businesses invest in accounts receivables automation before they fix their collection cadence. And the result is an automated version of their existing chaos. The right sequence in automating invoice issuance and delivery confirmation first, then automate the reminder cadence, then build a real-time DSO dashboard by customer, then automate the disputes logging and routing, and finally automate every early payment discount triggers and approvals. In that order, each step builds into the one before. Before we close, 5 questions, answer them honestly, not for me, just for you. Not as you wish the business were, but it is actually as today. Question 1, what is your current DSO and what was it 6 months ago? Question 2, who specifically owns the receivables in your business? Not the finance team in general. a named individual with a target, authority, and accountability. Question 3, do you have a written DSO collection process that every member of your finance team follows consistently? Question 4, how many invoices are currently in dispute and how old is the oldest? Question 5, have your standard payment terms been reviewed commercially and financially in the last 12 months? Let me tie all this back together the way we started. Revenues up, bank accounts flat, the P&L showing growth, but the cash position refuses to confirm. This is not a mystery. This is a receivables problem, specific, structural, and entirely solvable. You know the formula now. You know the three root causes. You know the three-step cadence, and you know the math in the early payment discount. Also, I gave you the 5 questions that you need to answer yourself. So the action plan is there. You know what to do. All you need to do is to start. And if you want to take this further, if you want to have a structured receivables diagnostic on your business, quantify the cash opportunity and build a 90 days action plan to recover it, happy to have a conversation. Uh, just reach out to me. You have all my coordinates just coming up. Um, and also, as I keep telling you, subscribe if you really want to know more about diagnostic frameworks, because these frameworks are meant for all the mid-market CEOs, CFOs, and leaders and founders who want to run businesses the way they would want to, but something just crops up that derails their entire uh, transformation journey, the business journey. These sessions are meant to uncover the 3 to 5 steps changes that need to be done to get the businesses back on track. So you have my coordinates on the screen. Happy to have a conversation. Until we speak next time, take care, stay safe, and we speak soon.